Good morning, everybody. You are watching live Daily Market Outlook for Monday, 4th of March 2013, prepared by Windsor Brokers. We're at the beginning of a new week, and I would say brief consolidation so far seen during the Asian session is seen after a quite turbulent end of the last week, where the US dollar remained as the top performer and still holds the positive stance, pushing its counterparts to the lower levels. More significant points seen basically on all instruments. Euro-dollar cracked psychological and previous low 130 support on last Friday's sharp fall to 129.65. Heavier losses seen on the British pound against the US dollar as the pair also tested and dented the 150 our short-term target that has finally been reached. 149.83 was seen on the spike lower in the late afternoon trading of American session, with brief consolidation now seen within the narrow range, holding above 150. Dollar yen reached fresh high at 93.67, averts immediate downside risk that was triggered on a break below 92 base, recovering past couple of days, and the approach to the 94 psychological barrier that would open again upside targets at 94.45.55, and our short-term target at 94.97 2010 high remain now firmly in play. Brief consolidation was seen, but if we follow the pattern of the previous movements from 90.85 low of last Monday, then this is expected to be mild, and most likely fresh extension higher is seen as a likely scenario according to the current technicals for dollar yen. Of course, we are going to take a deeper look on each instrument in our technical part. Just to mention that dollar Swiss remains well supported, consolidating a fresh rally last Friday's strong gains that reached 94.61, and now cracking a 200 days moving average, and slightly closing ending week slightly above this level, and now sees more potential towards next upside targets that are at 95 zone, where we have 94.95 Fibonacci resistance and 95.11 previous high. Commodities remain under pressure, especially crude oil that sank to 90.04. Level I think I mentioned in the previous sessions is seen as a psychological support, and it's just close to 61.8% of entire recovery rally from 84.05, seeing a fresh extension of the pullback from 98.63 as a likely scenario, as a negative structure on the lower and the larger time frames sees more downside potential. Also gold holds a negative tone as upside rejection seen last week at 16.20, and the subsequent fall down to 15.64 that nearly fully retraced 15.54 to 16.19 rally again sees more risk towards the downside. The brief consolidation is seen during the Asian session, and the most likely scenario for now is seen towards the downside as long as we are holding below 1600. From the fundamentals, Italy remains in focus as Italian President Napolitano now is looking for a possibility of forming another technical government that was the previous one with the Mario Monti, with the finally no final decision from the elections, and having difficulties as none of the leaders is giving up. Most likely scenario will be again a technical government in Italy that is of course pressing the single currency. From Japan, the government's nominee to be the next central bank governor, Kuroda, outlined the more forceful policy prescriptions today to finally defeat deflation. He said that he would not set any limits on the amount of cash the Bank of Japan pumps into the economy. Underlying expectations, he would be an aggressive governor, and the lawmakers of the will be the aggressive governor with the Bank of Japan's current policies were not powerful enough to boost inflation to 2% target. He said the central bank should strive to achieve in 2 years. The other thing important is Chinese reaction that actually kept the pressure on the Aussie dollar during the night. The China could increase required down payments and loan rates for buyers of second homes in cities where prices are rising too quickly. In the central, the State Council said in the central government's latest move to contain the housing costs, local governments must set home price control targets in the first quarter. The central government said in a statement, and the State Council, China's cabinet on 20th February meeting restated its intention to extend the pilot property tax program to more cities and urged the local authorities to put price control targets on new homes. As said, Aussie dollar slid below the recent range floor at 101.50, and they reached fresh 8 months lows that are currently at approximately 101.14. Our next target is at 101.00. Also, the Chinese stocks were lower. China's Shanghai Composite Index tumbled 3.2%. Following the news that we mentioned that Beijing announced more property market tightening measures in a bid to contain housing costs. And these were basically the main drivers of the markets last Friday. And during the Asian session from today's calendar, before we move to the technicals, number of releases. We already had commodity prices, the most significant building approvals in Australia significantly fell according to expectation. Minus 2.4 was the release seen overnight. Okay, better than December's minus 4.4%, but quite away from the optimistic plus 2.9 forecast. Keeping the negative sentiment still in play. Another positive release was the Spanish unemployment change in February that showed a further drop in the unemployment to 59.4 thousand compared to January's 132.1 thousand and the forecast at 77.5 thousand. Still to come, Centix investor confidence for March for Eurozone is showing a negative outlook according to the forecast at minus 0.4%, which is above previous release of February that was at minus 3.9%. And basically the most interesting and the most significant release today during the European session is UK's construction PMI for February, due at 9:30 GMT. 49.2 is today's forecast compared to 48.7 in the month of January. Well, we're still below the breakpoint at 50.00, but positive tone that is seen on the forecast will reflect greatly the weak British pound in case of release near or above the forecasted level. Basically, the sterling is now awaiting release of this indicator to get some fresh direction. Eurozone PPI due at 10 o'clock GMT for January, 0.5% is today's forecast compared to December's minus 0.2%. And the FOMC member Janet Yellen is due to speak at 1300 GMT. And these are basically the highlights for today from the economic indicators. We're going to move to the technical part, which we have quite interesting situation in every single instrument. We'll start with the single currency as we usually do. As shown on the daily chart, a reversal from a 137.10 1st of February peak is gaining pace after the pair took the 61.8% retracement at 130.61 and cracked the next support, which marks the low of 4th of January 2013. This was the previous yearly low. On extension lower down to 129.65 seen last Friday. Prevailing negative tone is seen on the daily chart with no signals of reversal yet that sees potential for further extension lower. On the downside, we have channel support that already contained the dips last Friday. Now the next level where is channel support is around 129.50, while Fibonacci 76.4% of the 126.60 to 137.10 is at 129.08 and is seen next in case we break below the channel support. That will of course trigger the further acceleration lower, and 128.75, which is our next important level. This is 50% retracement of the longer term 120.42 low of 2012, July 2012 to 137.10 peak of 2013, and this is at 128.75. Basically, this is, as we mentioned in our previous sessions, this is our near-term target for the single currency in the coming sessions. The target is also reinforced by previous lows of November and December 2012 at levels approximately 128.75.80, quite a strong support and seen as the next downside target. Conversely, any bounce higher as the pair is correcting around, hovering around 130.00 with again a fresh attempt seen the beginning of European session. The price dipped to 129.86. Still firm focus seen towards the downside. Last Friday's intraday high, it's at 130.40 and seen as the initial resistance. This is also close to 38.2%. Actually, it's exactly 38.2% of the latest downleg from 131.61 to 129.65. While any significant improvement in the near-term structure requires break above 131.00, which also marks last Friday's high, and it's between 61 and 61.8 and 76.4 Fibonacci retracement of the latest downleg from 131.61 to 129.65. Any break above 131, as said, would ease the immediate bear pressure. However, we need to see more gains towards the upside, 131.61 to be regained in order to confirm a near-term base. Otherwise, focus remains firmly on the downside as the pair is now holding at 130.00, and that psychological target has already, psychological support has already been cracked on last Friday's move lower. That signals possible further extension lower, despite again Friday's closing slightly above this level. More bearish tone is expected in the coming sessions. British pound was the top loser last Friday, as we can see on the hourly chart. Sharp fall from levels just under 152.00, dipped initially to 150.10 and then spiked lower to 149.83, cracking our initial target and psychological support at 150.00. A brief consolidation is seen now, as we said. Hesitation at or above this level could be expected, as this is quite a strong support, and of course oversold near-term conditions might see some rather consolidative than corrective action at this point. And this is seen on the UK's PMI, construction PMI data that might give some acceleration either upside or downside now, depending on the release. But initial resistance is now under pressure, which is approximately 150.40. These are the current consolidation highs, while more significant one is at 150.70 zone, where we have the 38.2% retracement of the recent downleg, as well as a previous low of last Monday, following up lower opening at 150.69. The current resistance is also reinforced by descending 55 days exponential moving average, and also there is the low of 27th of February at 150.80. So basically under 151.00 we have quite a strong resistance area, starting with 150.70 and then 151, which is halfway, 50% retracement. Break above 151 would signal easing of the immediate bear pressure and would allow for some possible stronger recovery. But important to mention that a previous range previous range low, that is at 150.70, is now acting as initial resistance, while the range top at 152.20 is seen as the near-term break point, and the only break above 152.20 would provide the near-term relief and avert immediate downside risk. That is still focusing targets on the downside. We can see it on the monthly chart. 149.00 is a round figure, and then 148.53, which marks 61.8% Fibonacci retracement of the longer term 2009 to 2009 rally from a low of the year at 135.01 and the high of 2009 at 170.41. That is basically seen as our next target. As a strong bearish signal we mentioned in several previous sessions. Strong bearish signal was given on the break initially on the main break below main bull trend line, which was at approximately 157 zone, and then another significant point was multi-year congestion low at 152.50.30 zone, break of which is now opening way for a possible further full retracement of 135 to 170.41. Of course, a long way is still ahead, but extension below 149 and test of 148.53 that is seen as our next downside target could have great impact on the current bears, and look for possible extension down towards 142.30 that will be in focus in case of penetration of 148.53, and this is 1st of May 2010 low. Overall negative tone still dominates on the lower time frames. Some corrective action could be seen as hourly indicators are coming out of the oversold territory, as well as bearish divergence now seen developing on the 4-hour chart of MACD and the RSI could give us some signals for a possible stronger recovery as the pair consolidates above previous above the support, strong support at 150.00. Again, penetration of 151.00 seen as initial, and then break above 152.20 is required to improve the near-term structure. Dollar yen brief look stays well supported for now, following a strong recovery from 90.85 last Monday's low, with fresh upside action seen at the beginning of European session after gains reached 93.71. This was the highest seen during the Asian session, and this also marks exactly 70.4% Fibonacci retracement of entire 94.55 to 90.85 down move. Positive tone that prevails on the lower time frames sees potential for possible break above 94.00. That will at the later stage open way towards our previous peaks, 94.45 and 94.55, and possible stretch towards our short-term target at 94.97, which is the high of 2010. Corrective easing seen of overnight's low, overnight's high, pardon, at 93.71 was contained at 93.27 by 1 hour 20 days exponential moving average, and this is seen as initial support ahead of other significant levels that should be watched. We have 93 psychological support and also 23.6 retracement, and then 92.62, which is the equivalent to the previous high of 28th of February, as well as 38.2% Fibonacci retracement. Bullish crossover of 20 over 55 days exponential moving averages at 90 to 85 is underpinning the action higher now, and ideally any dips should be contained at or above 93.00, 92.80 in order to keep immediate bulls intact for eventual test of 94.45.55, and then final thrust towards 95 2010 10 high and our near-term target. Dollar Swiss remains well supported, as we can see on the daily chart. A strong advance of 90.20 low of 1st of February 2013 has cleared our long-awaited targets, 93.80, 187 double top, 94.00, and finally cracked the 200 days moving average at 94.30. Friday's close at 94.32, just 2 ticks above the moving average, sees now potential for a further extension higher, and we'll be looking for test of strong resistance zone at 95, at where we have a 94, 95, 50% Fibonacci retracement of down leg from 2012 peak at 99.70 to 2013 low at 90.20, as well as previous high of November 2012 at 95.11. This is seen as our next upside target, and now the supports at this point are seen as follows. The initial one, 94.14, where the overnight trading found support following pullback from 94.71. Then we have 94.00 is a round figure, and near 38.2% retracement of the latest upleg from 92.81 to 94.61. Ideally, any dips should be contained somewhere at 94.00 or 93.70. That marks a previous high of 28th of February, as well as 50% retracement of the entire rally, in order to keep bulls intact for a final push towards 95, our next target zone. However, any extension lower will still keep the bulls in play, while we are holding above 93.45, which is 50% of the larger 92.29 to 94.71 rally, as well as previous range tops at approximately 93.40. Only penetration of these levels could weaken the near-term structure. Hourly studies our indicators are now in descending mode, and this would likely prompt some stronger corrective action, while 4-hour indicators currently slightly overbought, again see potential as RSI is yet not showing any reversal signal, holding in the overbought territory. MACD is also extended but pointing higher. Momentum is slightly skewed towards the downside, and stochastic is also pointing lower. That overall may trigger some corrective action, but if we follow the previous way of trading, where one advance higher was followed by brief consolidation within the rather narrow range, the same scenario would apply at this point, and ideally any dips should be contained at the previously mentioned levels around 93, 92.80 in order to, if I mention the correct levels, or 94, 93.80, and not to exceed the 93.50, 93.40 levels, in order to keep immediate bulls intact. And the crude oil, that is also under strong pressure, is now again attempting on last Friday's low at 90.00. Most likely an extension lower is seen as the pair, as the price breaks below 200 days moving average that is currently at 90.46 on last Friday's extension lower that dipped to low at 90.04. This is the lowest seen so far, with overnight sessions low seen at 90.07. Still more pressure is seen towards the downside, as larger picture indicators are well in the negative territory, while overextended hourlies see potential for some consolidative action, but still bullish structure remains intact, and the most likely scenario will be fresh extension lower, where we're looking for a test of 89.90. This is initial one, and then 89.00 is around the figure support ahead of on the larger picture, of course, entire rally from 85.20 to 98.63, where we have 76.4% retracement at 88.37. As set break below and close below the 200 days moving average is seen as additional pressure for the oil price that is in descending mode since 13th of February from its peak at 98.63, with the important levels being cracked so far, and seeing more potential towards the downside. And finally, the quick look at gold. It seems that it's again creating a diamond pattern consolidation following dip to 1564 on the pullback from 1619, where the price action failed at our target, and the 50% retracement of down leg from 1684 to 1554, and steady decline nearly fully retraced the rally from 1554. Temporary support was found at 1564 last Friday, but as gains were limited by descending 20 days exponential moving average. Again, more focus and more pressure seen towards the downside, as 4-hour indicators are negative and still pointing lower. That overall focuses initial target at 1564, and the final one at 1554 that would risk extension down towards our critical support multi-year range floor at 1520 zone. These are the lows since 2011, and basically break below this, as we elaborated this in some of the previous sessions, would be as a good signal for a more significant corrective action of over 10 years rally of yellow metal that so far did not record any stronger corrective action on the rally from approximately $300 per ounce to nearly $2,000 per ounce posted in 2011. 1920 was the historical high seen for the yellow metal. Back to the near-term studies, hourlies are still in the red territory following upside rejection overnight at 1584. Failing to clear last Friday's high at 1587, and this is now seen risking further extension lower, despite overnight's gap higher opening, a slight gap higher that has already been filled, and at this point we see more focus towards the downside. The initial support 1572 has already been tested, looking for 1564 and then 1554 in extension. Any retracement higher should clear initial barriers 1584 and more significant 1587. That is approximately 38.2% of entire 1619 to 1564 descent, and break above these levels, and again significant 1592, which is close to it, 50% retracement would provide the near-term relief. However, anything below psychological 1600 level that is also close to 61.8% retracement would still keep the downside at risk. And this is all from my side for today. Please, your questions and comments, you can type them and send them now. Yeah, good reminder. Aussie dollar, we missed it. I mentioned it at the beginning, so it's as a request came, it's good to take a look. Basically, the strong bear trend of recent peaks posted in January 2013 at 106 level that was close to the larger range, as we can see it better on the weekly chart. Larger range that was established between 101.50 and 106.20, as the last Friday's and overnight's extension lower cracked this level 101.14 seen so far. Negative tone is still seen favoring the downside, especially that break below 105, part of 101.50 triggered some stops. This was basically prompting the extension down towards 101 that is seen as our next downside target. Break below 101 is to open 138.2% extension, Fibonacci extension, that is at 99.76, and then we have 98.70, 161.8% Fibonacci extension of the down leg from 105.97. This is the peak of 6th of January 2013. Hourly studies are negative and quite oversold at this point. That may suggest some corrective action. We can take a look at the Fibonacci levels of the entire of the latest down leg from 28th of February high at 102.89, where we have 101.55, which is at 23.6%, and also is the previous range low seen as the initial resistance. This is previous very strong support, now acting as resistance. 101.81 is the previous low of last Friday. Also 38.2% retracement. At this point, strong support, strong resistance, pardon, and the near-term break point is seen at 102, what is 50% retracement of the down leg from 102.89 to 101.14, reinforced by descending 55 days exponential moving average. And I would say at this point, break about 102 is to delay immediate bears and avert immediate downside risk. Yet a lot of work seen on the upside in order to prevent fresh weakness. Minimum 102.89, 103.00 is required to be regained in order to shift the near-term focus higher. Otherwise, any brief corrective action will face 101.50, 101.80, and then strong barrier at 102.00 on the downside, as we said, 101, and then Fibonacci extensions 99.76 and then 98.71. Any further question, please? Just to mention, anyone whoever connected later can find the recorded version in the YouTube under Windsor Brokers Forex session is recorded and will be loaded there in a while. Of course, any comments, any suggestions, you can submit them on analysis at windsorbrokersltd.com. Since we don't have any further questions, we will conclude today's session. It took us quite a long time. We are back again tomorrow morning at our regular time at 8 o'clock GMT. Also, you will receive on a daily basis written comments and technical analysis for majors, commodities, and crosses. If you are a client of Windsor Brokers, then you receive it on your trading platform. Expect to see you again tomorrow morning at our same time when we will see the situation in the markets and review our technical outlook. Until then, I wish you a nice Monday beginning of new week, and good and successful week, and of course the most important thing, profitable trades. Good luck.